All right, let's get right into it. If you're running a successful EPC or infrastructure company, I'm willing to bet your bankers absolutely love you. I mean, you've worked for years to get to this point. But what if that very success, that gold standard status, is actually hiding your biggest risk? Today, we're going to break down why your amazing bank guarantees just aren't enough anymore, and how something called a twin-engine growth architecture might be the real key to unlocking your next level of scale.
Does this sound familiar? Yeah, I thought so. You've fought the tough negotiations, you've built a flawless track record, and you have optimized every single basis point. You've done it. You have what everyone in your industry wants, that perfect, super low-cost bank guarantee setup.
And seriously, for that, congratulations are in order. You've totally mastered the first part of the game. You won those negotiations, you earned the deep trust of your banks, and, on paper, your whole setup looks just perfect.
Well, here's the twist. It's a risk because the game has completely changed. That amazing optimization that got you here, it's now creating an invisible ceiling on your growth. The thing that feels like your greatest strength has a hidden and very, very critical limitation.
So let's talk about this illusion. While you were busy perfecting the pricing game, getting those costs down, a whole new game started right under your nose. And this one, it isn't about cost at all. It's about capacity. You know, what's really fascinating here is the massive shift in focus. The old game, over on the left, was all about unit cost, shaving a few basis points off the commission, getting unsecured terms. Those were the big wins. But the new game, on the right, it's a different beast entirely. The real bottleneck now isn't price, it's your bank's total exposure limit, those internal caps your bank has for your sector, and the huge risk of having all your eggs in one or two banking baskets.
And this right here is the problem. You can have the best BG pricing on the planet, but if your lead bank's credit committee wakes up one day and decides they have enough exposure to your industry, your growth just stops, dead in its tracks. You're hitting a capacity ceiling that has absolutely nothing to do with your performance or the price you're willing to pay.
So the big question is, how do you smash through that ceiling? You do it by adding a second engine. Now, this is not about replacing your fantastic bank relationships. No way. It's about complementing them with a brand new, parallel source of capacity. Surety bonds.
So what exactly are they? Well, to put it simply, a surety bond is a guarantee that acts just like a BG. But, and this is the key part, it's issued by an insurance company, not a bank. The wording can be identical, clause for clause to your performance guarantees, but the balance sheet standing behind it is completely different.
A well-structured surety program is just such a powerful strategic move. First, it creates a whole separate pool of guarantee capacity that doesn't even touch your bank limits. Second, it works on a simple premium model, which means no block cash collateral, no fixed deposits tying up your capital. And third, it diversifies your risk. Suddenly, you're not just relying on one or two banks, you're spreading it across a panel of highly rated global insurers and reinsurers.
And this right here is the core idea we're talking about, the twin-engine architecture. Your BGs, they're still engine one, cost-efficient, relationship-driven, absolutely perfect for the job. But surety bonds, they become engine two. Your off-bank, capital-light capacity booster, always ready to fire up and power your growth when engine one hits its natural limits.
And this brings us to what this is really all about, the real prize. See, once you're in that gold standard zone, the game isn't about saving a few more basis points anymore. The real game-changing value comes from unlocking a massive amount of new capacity.
I mean, what kind of capacity are we really talking about here? Think about it. What would it mean to increase your ability to issue guarantees by 20, 30, maybe even 50% or more, all without having to renegotiate every single limit with your banks and without putting more stress on your balance sheet? That's the kind of jump we're talking about.
Let's make this real for a second. Just be honest with yourself. How many times has your team looked at a fantastic opportunity, a perfect tender, only to say, our BG headroom is a little tight this quarter, we should probably pass on this one?
Or how about this one? How many projects have you had to put on hold, not because they weren't profitable, but because you were literally waiting for older guarantees to expire just to free up enough room to even bid for the new ones?
And here's the real kicker, the risk scenario. What happens to your entire growth strategy if your main bank gets a new directive from on high to pull back on your sector? With only one engine, your whole order book could be frozen overnight.
Okay, so let's imagine this new world. Let's picture life with this new blueprint. What actually changes on a Monday morning when you have both a BG engine and a surety engine running side by side?
Well, your whole strategic conversation, it just transforms. You move from that defensive, capacity-driven mindset on the left to an offensive, return on capital mindset on the right. The big question is no longer, can we even do this? It becomes, should we do this? Is the return good enough? It's a fundamental shift from being constrained by your resources to being led by your strategy.
And the practical advantages, they show up on day one. You can bid on more projects, way more aggressively. You free up your primary bank lines to focus on what they do best, like providing working capital. You literally build in a shock absorber against market stress, and suddenly you have the flexibility to go after strategic acquisitions that your single-engine competitors can't even dream of.
But look, this isn't just about growing faster. It's about growing stronger. And there's a really powerful governance story here that your board, your investors, and any rating agencies are going to want to hear.
The crucial point is this. When you implement a twin-engine architecture, you send a crystal-clear message to the entire market. It says you are sophisticated. It says you are proactive about managing risk. And it says you are building a business that is not just getting bigger, but is becoming more resilient.
Think about it. When a credit committee or a rating analyst looks at your company, they see that you've actively de-risked your own growth. You've diversified your guarantee providers. You're using globally rated capacity. You have a disciplined, modern capital structure. That is a narrative that builds incredible confidence.
So let's bring this all home. If you are in that gold standard zone with your unsecured, low-cost BGs, you have done an absolutely excellent job. You have built and you have perfected a world-class first engine.
So the real question now is, what's next? The next frontier for your company isn't about shaving another few basis points off a fee. It's about building the second engine that will unlock your next huge phase of growth, making your company not just faster, but fundamentally stronger and more resilient. So, are you ready to build it?